Hey everyone, welcome back. Today I want to chat with you about 30-year mortgages versus 15-year mortgages and whether or not it's smarter to get a shorter term mortgage or a longer term mortgage and then pay them off as quickly as possible and then start investing the money. As always, welcome back to the channel. My name is Levi Woods. This is Drawbridge Finance. I'm not a financial advisor. I don't work in the finance industry, and this is an opinion channel about money. I don't offer financial advice of any sort on this, but I do get lots of questions from people. So if you guys have a financial question and you think that I might be able to answer it or shed some light on it, then please leave it down in the comments below, because I love to delve into these questions so that I can kind of educate myself and therefore educate you guys, and we can learn together, because the goal is for us to all get rich together. Anyways, today's question comes from a viewer who is asking about a 15-year mortgage versus a 30-year mortgage. So I did a little bit of research on this, and I found out that in the United States, which I'm sure this viewer is from, because in Canada we don't have 15-year mortgages or 30-year mortgages. They're just not really accessible to us. So for my Canadian viewers, this is kind of more skewed to the American side. But I think the information is useful nonetheless, because it just gives us an idea of what happens when our term is longer or shorter, and if we aggressively try to pay it off. So today what I'm going to do is I'm going to set up a scenario with 4 characters. They basically all have a similar scenario. They're going to buy a $250,000 house. They're going to put $50,000 down, and they're going to have a $200,000 mortgage. Now, I looked at average mortgage rates in the United States, and I came up with 2 figures. If we get a 15-year fixed rate mortgage right now in 2019, we can get 3.375%. If we get a 30-year fixed, we can get a 3.875% annual mortgage. So that kind of gives us an idea. The 30-year mortgages are slightly higher percentage-wise. So off the cuff, I mean, I would think that it would be obvious to get the lesser rate. I mean, if you can get it for 15 years and you can afford to make those payments, then why wouldn't you get the shorter term and pay less interest? But I'm going to delve into the numbers specifically, and we're going to look at it through an amortization chart. Specifically, the spreadsheet that I'm using today is one spreadsheet that I generated. It's the mortgage repayment calculator versus investment returns spreadsheet. And it's available on my Etsy store if you guys want to download that there. Otherwise, my top level tier patrons also get to download these files for free. They're available as digital downloads along with all of my other files. So consider becoming a patron of mine. You can follow my trades if you haven't already. If you're new to the channel, remember to hit that subscribe button down below and click like, because this video is going to blow your mind. We're going to dive right into the numbers right now. And what we're going to do is we're going to compare 4 characters. So Alice, Bob, Charlie, and Doug. And all of them have $1,800 that they have allocated towards either their mortgage or towards their investment. And what I'm going to do is I'm going to show you the breakdown. So Alice and Bob are going to sign up for a 15-year fixed rate mortgage at 3.375%, and they're going to have a monthly payment of $1,417. That's going to be their monthly mortgage payment. But as I said before, they've got $1,800. So the majority is going to the mortgage, and they're going to have this little bit extra. It's $383. Now, Alice is going to put that into an investment. She's going to invest it into a simple ETF. Keep it really, really simple. If you guys are interested in investing, which I hope you are if you're watching a channel like this, then you should check out how to make 7% returns every single year. What she's going to do is she's going to invest in an ETF that returns an average of 7.8% per year, and has done so for the last 25 plus years. Now, Bob, on the other hand, is going to take his $383, and he's going to try to pay down this 15-year mortgage even faster. He's going to take the $383 and put it towards the mortgage. Now, Charlie and Doug, they've decided they're going to go for the 30-year mortgage, and it's going to be a slightly higher percentage, 3.875%. Their monthly payments are going to be substantially lower. $941 monthly is their regular mortgage payment. So Charlie has decided he's going to invest that money. He's going to have $859 to invest. He's going to invest it in a similar ETF that Alice does. For this, we're going to calculate off 7%. Doug is going to take his money, the $859, and he's going to put that towards his mortgage so he can pay down his mortgage faster. Now, that's a substantial amount. He's nearly doubling his monthly payment, which is amazing. So what we're going to do is we're going to flip over to the chart, and I'll show you guys how it works. So when you download it, it's got some stuff pre-filled in, but basically what you can do is adjust the white cells. So I've already pre-filled this out. The loan amount is $200,000. The interest rate is 3.875. The term is 360. You can change this to whatever you like. And then the extra monthly payment. Now I had rounded in the other chart 859, but this is very specific. We're trying to target 1,800 exactly. So the normal payment's $940.47, and the extra payment will be $859.53, giving a total monthly payment of $1,800. Then we're going to put the investments. We have an estimated return of 7% annually, and because you guys are American, I've lowered this capital gains. And in Canada, we pay about 21.5% in capital gains, but I'm pretty sure most people pay only 15% in the United States. So I've lowered this to 15%. And then we can just look at scenario A and scenario B. So scenario B is going to be Charlie, and at the end of 30 years, he's going to have a net worth of just over $1 million. And Doug is going to have a net worth of just over $900,000. We'll look at the invest before making extra mortgage payments, and we'll look at this chart specifically. And we'll scroll down to month 180 so you can see where I got these numbers that we're using. So in this column, so this would be if we paid the mortgage as normal, which is what he's done. He's made his normal mortgage payments, and then he's got this $859. So this is Charlie we're talking about. He's put $859 every single month into an investment, and his current investment value is worth $250,139, but he still owes $128,000 on the mortgage. Now, everyone else at that 180 mark, if we look at Doug, for example, he's mortgage free and has been mortgage free for a little while. He's been mortgage free 139 months. It only took him to pay off that mortgage with those giant extra payments that he was making. So we'll look at this, and I'm going to populate this so you just have an idea. At the 15-year mark, 3 of the 4 characters are mortgage free, making these extra payments. 15 years, obviously, both these characters were going to be mortgage free. Bob has been mortgage free for a little bit, and he's already been contributing to his investments. Charlie, on the other hand, he still owes this mortgage rate. So on that chart that I showed you, that's where I got those numbers. The investments are worth $350,000, but his mortgage is worth negative $128. Now the net difference is $121,911. Now I know that all of you guys are going to comment about like the house value increasing and the interest payments and all of that, but you have to remember that in a scenario like this, when we project things like this, that all of the scenarios are the same, whether or not the house still has a mortgage payment remaining on it, or whether the mortgage is fully paid off, that house value is the same. If somebody chose to buy or sell that house, they have the value that they have put into their mortgage, but the resale value is there. So this really is net money, $121,911. And the reason that I'm showing you guys this, because in this scenario that I've set up, which is more than generous, 7% return annually with 15% capital gains, Charlie's actually the winner in this scenario at the 15-year mark. He has more net worth than anyone else in these character scenarios. So now let's skip forward to the 30-year mark, and we'll just look at the end of 30 years, who is the leader. I can tell you, because it's a percentage-based, Charlie still is going to be the winner in this case. Of course, Alice and Charlie are the big winners. Now, this is not really a competition. I'm not trying to persuade anybody to pay off their mortgage or to invest or do any of those things. I just want everybody to be informed, because my assumption with looking at these numbers in the beginning was that a 15-year 3.375% would actually generate more income than a 30-year at a 3.875%, considering the investment was the same return. But that's not actually the case. Charlie actually has generated more money, and part of that has to do with his capital gains. Now, of course, this is where everybody should be running the numbers on their own. They should be sitting down with a certified financial planner, and they should be looking at what their tax bracket is, how they can earn these investment dollars without actually paying so much capital gains. Because Alice was in a situation, she was only paying $383 towards her investment each month. That is well below the $5,500 Roth IRA maximum contribution in the United States. So there would be no reason why she couldn't have had all of this $383 tax-free. So in that case, this would have brought this number up to well over $1 million, and it would have been much closer to Charlie. because it was such a small amount. Now Charlie, because he's putting in $859 every month, he doesn't have that same leeway. He can't contribute it all into a tax-free account. This is really where you have to sit down with a tax professional and figure out these things on your own. So using the charts are a good basis so you have an idea of what's going on, but really when it comes down to the nitty-gritty, you need to seek professional help. Now, I'll also include the total interest because everybody's always interested in that. So even though Charlie has the greatest net worth at 30 years, the interest that he paid was much larger than everybody else. He also paid more capital gains than everybody else. But the simple fact remains that the investment was garnering at a greater return than the mortgage was losing. So even with that tax, that extra tax that he had to pay, it still worked out in his favor. He became the wealthiest of these four characters. Now, again, none of these are bad choices. These are all good. And I think that most people fall into the category that I do, which is I make some extra mortgage payments, but I also make some investments. And I kind of blend the two so that I can get to a place where my future self has the best well-rounded portfolio that I can possibly have the least risk, and have the most amount of money that it is comfortable for me. Anyways, I hope you guys enjoyed this video. I hope you get a chance to download the files. I'll put the links in the description below so you can check it out, because I would love it if we can all get rich together. Thanks so much for watching, and see you very soon.